Hi, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and welcome back to The Pulse, where we take a month-to-month look at what happened in the economy and the capital markets so you make better decisions in your business and with your investments. Let's start with the highlights. International equities continue to outperform, helped by a weaker dollar. And credit spreads remain tight, signaling that market confidence and stability, but investors are watching the impact from two recent bankruptcies. CEOs are responding to a resilient economy by boosting capital spending, betting on future growth and productivity. Meanwhile, inflation is broadening, putting pressure on margins and forcing businesses to sharpen their pricing discipline. Now, let's take a deeper look at the data, see what else we can learn. Recent market performance has been mixed in stock and bond markets, reflecting concerns over economic growth from soft employment numbers. Now, for the month, emerging markets lead, and the Nasdaq is higher, while everything else has declined. For the year, international stocks continue to greatly outperform domestic, with the more cyclical S&P equal weight, Dow Jones, and S&P small cap sporting single-digit returns. Bonds also reflect concerns about the economy, as for the month, investment-grade corporate and government bonds are higher, while high yield has declined. Now, year to date, performance has been remarkably identical across governments and corporates. Oil continues its rough patch, while copper and Bitcoin march higher on growth of AI. Markets now price in 2 more rate cuts this year and roughly 1 per quarter through mid-2026. This should support riskier assets and small business borrowing. Even after recent U.S. rallies, international markets, especially developed, are still leading for the year, outperforming the S&P 500 and Nasdaq by about 1,000 basis points. A key reason is the weakening dollar, which is down about 10% for the year. The dollar is still above pre-pandemic levels, which means there could be further downside. S&P 500 earnings for the third and fourth quarters are expected to grow, but analysts are currently baking in at rates lower than they were in the first half of the year. We believe this may prove too conservative. With Q1 and Q2 beating expectations, current earnings forecasts may prove too cautious. There's more certainty about the operating environment today, and we believe we could see earnings revisions higher, which could increase stock prices through the end of the year. Credit markets are pricing instability. High yield and investment-grade spreads remain tight, even after 2 surprise bankruptcies. Markets are pricing in resilience, not broad credit stress. Despite tight spreads, CDS prices have jumped. Investors are selectively hedging against credit defaults after the surprise First Brands and Tricolor Automotive bankruptcies. Now, they're buying this default insurance to protect downside. Yet, big picture, economic data points point to a resilient economy, with the Atlanta Fed's GDP now forecast above 3% for the year. Business leaders are leaning into growth. Capital spending has steadily increased for the last several months. And consumer spending remains steady overall, despite the headlines about imperiled consumer. One reason that the consumer is spending is that business productivity is rising and wages are keeping pace, suggesting that businesses are investing in efficiency and workers are benefiting from that. While you might not see it in the headlines, wages adjusted for inflation are improving across income levels, reinforcing consumers' ability to spend. It's not a picture without concerns. Unemployment remains low overall, but younger workers, here in blue and teal, face higher joblessness as employers prioritize experience. This is not new. This started several years ago. And according to ISM surveys, the situation doesn't look likely to change. Hiring momentum is softening in both services and manufacturing businesses, pointing to employers being more cautious on future hiring plans. One reason for that is inflation. Inflation is creeping up again, driven by goods prices, which adds pressure to margins and pricing decisions for employers who may be reticent to then add to labor costs. Now, core goods inflation, which is here in purple, has turned positive as tariffs have been implemented, while core services, which is here in gold, has been relatively stagnant. With more than half of the CPI basket rising more than 3%, inflation is becoming more broad-based. That kind of cost pressure forces tighter margin management and more thoughtful pricing. The concern being how much companies can pass through without seeing an impact on volumes. Price pressure is now coming from domestic goods, even those untouched by tariffs. That shift makes supply chain and sourcing decisions more critical as we head into 2026. To sum up everything from today, here are the key takeaways. Global equities are leading, helped by dollar weakness. Credit spreads remain tight, showing confidence, but investors are alert to surprise bankruptcies. CEOs are ramping up CapEx, while broadening inflation may impact pricing decisions and squeeze margins. With that, I'm Simeon Wallis, Chief Investment Officer of Aprio Wealth Management, and I'll see you next time with our next edition of The Pulse.